Hey, welcome back to the Ignite podcast. We're delighted to have Sailesh Ramakrishnan on the program today. Managing Director at Rocketship VC, has a huge passion for solving climate change, in addition to some space interests. Sailesh, thanks for coming on the program. We'd love to get an intro from you for the audience. Thanks again for coming on.
Likewise. Thank you for inviting me on this program. Happy to share both my experiences as well as my career with your listeners. So as you said, my name is Sailesh Ramakrishnan. I'm one of the founder managing partners here at Rocketship. I am a computer scientist by training. I came to the US from India. While I was in India, I got a bachelor's in engineering from the prestigious Indian Institutes of Technology, the one in Madras. And here in the US, I've been in several schools, Virginia Tech, University of Pittsburgh, and last was the University of Michigan, where I was working on my doctorate in computer science. While I was at Michigan, I got what I would call my dream job opportunity, which was to come work at the NASA Ames Research Center here in Mountain View, in the San Francisco Bay Area. So it allowed me the opportunity to both work at NASA on the Mars rover project, as well as work on my PhD at the same time. So it was such a good offer not to pass up on. So I happily moved from cold Ann Arbor, Michigan, to somewhat warmer, California. Spent a wonderful 4 years at NASA, working on a wide variety of algorithms and technologies on what was supposed to be the next generation of Mars rovers. But then I realized that I was in the heart of startups and innovation, being here in Silicon Valley. So I decided to leave NASA, and at that time, my current partners in the fund, they were starting their second company. They were also repeat entrepreneurs. So they started their second company, and the vision of that company was so audacious. It was super exciting to join them. They were trying to create a company, as in I should say, we tried to create a company where we were trying to disrupt how information would be presented to users who were searching for it. At that time, Google was the best way in which this would happen, but Google is just giving you 10 blue links as search results. And so we were one of the first companies to try and see if there was a way in which you could answer. And in some sense, if you hear me describe it, you realize that this was a precursor to how innovative the new language models are, and how much of the work we did almost 15 years ago is applicable to the problems of today. So it was a very innovative and far-thinking company. And over the years, we were acquired by Walmart in 2011. Because the technology we built to understand what was going on on the web could equally be applied to shopping and figuring out how users were buying things and why they were buying them and what they were buying next. I stayed on with Walmart for about 7-8 months, but the reason I decided to leave was, and it was very exciting to be working at the world's largest retailer. But once you have been through a startup journey, you really want to get that experience again. And I wanted to be a founder myself. Even though I was early in that previous company, I was not a founder per se. And so I decided to join another colleague, and we started a company called Lockbox. Lockbox created a marketing platform for small and medium-sized businesses. And we raised our Series A in 2012. And in 2014, we were acquired by Square. My co-founder and most of my team are still at Square, while I chose to transition out. And at that time, my current two partners, who were the founders of Cosmix, the company I joined right out of NASA, they also were free. And so the three of us got together once again, and we created what you see today as Rocketship. Rocketship is a quantitative VC where we use cutting-edge AI and machine learning algorithms to find the most innovative companies in the world today to invest. The way that works is the world is full of a lot of information about startups these days. And so we collect and simulate one of the largest databases of startup activity. Our data set currently spans about nearly 400 terabytes. And our machine learning algorithms then run on all of this data to predict the most likely successful companies at any given time. And unlike traditional VCs, who have startups come to them, we sort of tilt the whole format on its head, and we proactively go out and reach out to these amazing startups, and we try to convince them to take our money as well as try and understand the innovation they bring to the table. So that's what I'm doing today. It's a culmination of all of my interests in some sense. I'm a computer scientist, but I'm also really passionate about startups. There's something so innovative about this 0 to 1 transition that really makes it very exciting for me. And then through this fund, we are able to find and invest in some of the best companies all over the world.
Wow,
so that, in a nutshell, is a little bit about myself and my career story.
So many interesting corollaries. I think in 2012, I was running demand gen at Vertical Response, which was an email marketing company that targeted SMB. So you probably were familiar with us. And
yes,
at the time, we were getting our lunch eaten, of course, by MailChimp, who had a freemium model, and they were just killing us, killing our growth. And we ended up selling, I think, for like 1x revenue to Deluxe, the check writing company, the check printing company. So I think you probably had a better outcome than us selling to Square. And then, like you, I worked for a company with Rocket in the name, Rocket Fuel, which is an AI ad tech company back in the day.
I remember going to one of their events, and I think I have a water bottle with their name on it.
Yeah, a lot of swag floating around. I would love to. I still have some, almost 10 years later, still functional, like umbrellas and stuff like that. I would love to dig into, using a quantitative approach to VC. What stages do you go after? What's your check size and things like that? What's too early? What's too late for a quantitative approach?
That's a great question. And initially, when we started, since we are founders ourselves, we wanted to find ways to use our algorithms and find companies as early as possible. And so we thought seed or pre-seed would be the right place. But we realized very soon that, at least at that time, the data just wasn't there.
Yeah.
Right. And so while you can get a sense of the company, you can't really predict its future that early. So we slowly graduated up further to later stage seeds, and we found that the sweet spot was right around Series A. So we currently invest in some late stage seeds, mostly Series A's, and a few limited Series B's. Our check sizes range from 1 to 6 million, and our average check size is approximately 3 million. And depending on the kind of company, sometimes we double down twice, and so sometimes we go all the way to 6 million. Also, because our approach makes us a global investor, we have investments in 15 different countries. This check size moves up and down depending on the size of it.
Yeah, I love that. And so I could see why Series A would be kind of the sweet spot, because that's where the systems and the analytics and the data reporting and the governance and all that stuff starts getting put in place. Do you guys lead rounds? Do you prefer to kind of follow and be the second largest check, or what's your strategy there?
Again, very interesting question, and I'll answer it slightly in a different, nuanced way. The idea is that we want to lead all of these rounds because we get conviction very quickly. Most of the time when we talk to a company, the founders are excited because we are not coming at them cold. They are not pitching their company to us. Our algorithms have found these companies. We are going to them saying, hey, we think there's something fantastic happening. The challenge for us is not so much that we want to lead versus not, it's whether our check size allows us to. So there have been smaller rounds that we have led, and there have been larger rounds where we had followed. And when we say we follow, we make our decision very, very quickly. And then eventually we have to either wait for a lead to come in and set terms, or we make our decision based on who this lead looks like as well. Because over time we have learned that it's just not about the money as much as it's also about the other investors who are guiding the company, and so that makes a difference. So for the most part, depending on the size of the round, we are either a lead or a follow. But the nuance here is that from our perspective, we are always taking our foot independent and forward than other investors. So we're not just waiting around. We make decisions very quickly.
That's interesting. How many Series A fundings are there per year in the areas that you invested in? I guess another way of asking that question is, like, you invest in all geos and all sectors and verticals, or is there something or there's some, I won't touch these in your algorithm?
So the answer is, and I'll sort of answer this in a much more detailed form. Think of this as our algorithms allow us to handicap pretty much any sector and any company. So our algorithms see every kind of sector and every kind of. And then on top of that, what you just said, right? We bring some human biases, and biases here in the traditional machine learning sense, where we make some guidance choices. And the choices
still have a human in the loop. You're not completely handing it over to the algorithm to make the decisions.
Or in fact, it's significantly human in the loop. And so another way to think about our AI algorithms is they are like a co-pilot. They bring us to the right ballpark, but it's very much a human decision-making process that leads us to final sort of investment, if you will. And there's a large amount of sort of detail involved in that transition from when the data hands off to us as human partners. One of the biggest is the fact that the data cannot handicap everything that is potentially important in understanding the reward versus risk equation in a company. One of the key ones, for example, is the availability of capital. So we are a little bit more cautious in investing in companies that require large amounts of capital. As I mentioned, we are a relatively small fund. We manage just shy of 300 million today. And so for us, a company that needs something around the orders of 50 to 100 million in future capital would be a little bit of a risk to us because we don't know whether that capital is going to be available. And so we have to understand whether this company has that capability to get to a scale to attract that amount of capital. The second type of company that we are a little bit wary on is companies that have regulatory risk. So these are often binary risks that are only experienced really deep in the field people can handicap.
Right.
For an algorithm plus somebody like us, humans who are not necessarily experts in every area, to handicap whether regulation will approve a drug or approve a particular medical treatment is not something that we are very capable of. So that's another risk we don't take on this side of the regulatory risk. On the other side, obviously, that risk is removed and then we can consider it. So those are a couple of areas where we don't. But the right way to think about how we do this is to assume that our algorithms see everything, and everything, of course, has exceptions, right? So, for example, if you come across a drug that is phenomenal in its early test, then maybe there is a worth in taking that risk, irrespective of whether it's this side of the FDA or not. So we never say never, but there are a few areas where the humans come into the loop. And another way to sort of also illustrate the question in terms of numbers is approximately our algorithms propose somewhere in the range of 100 to 120 companies a month, as these are the best companies in the world to look at. And so that equates to approximately 1,500 companies a year. That's not the total number of Series A's. That there are many, many more companies that get funding. But these are the set of companies that our algorithms, from their perspective, believe are the best companies in the world for us to take a look at.
Yeah.
So from there, and this again illustrates how selective we are. Even out of the 100 companies, our investment rate is approximately 1.3. So 1 in 100 companies is what we finally end up investing. So even with being in the best ballpark, we are even more selective as to which one we want.
Yeah, and so for quick math, that's roughly 15 companies a year over like a 3-year deployment period. So you're doing like 40 to 60 in each fund. Does that sound right?
So that's those are averages, and the real numbers are given the size of our fund, which is approximately 100 million-ish for each fund. We target about 25 companies.
Okay, so pretty concentrated.
Yeah, reasonably concentrated, and we don't want to sort of have this spray and pray approach, because that really dilutes the value that our algorithms bring to the table. At the same time, the algorithmic spread where you want to de-risk a particular investment, you need to do a minimum number of investments.
Right.
So there's a balance between too little and too many, and between 20 and 25 is where our algorithms tell us.
And I think at Series A, I think that's probably the right number. I think for pre-seed, if you run a Monte Carlo on pre-seed investing, and a lot of people have done this research, where they run, I don't know, millions of simulations, the optimal number For a pre-seed, it might be like more like 80 or 100. But yeah, I can see like you're going to ask them to up down a little bit to closer to the stock market, kind of getting the beta of the stock market or what have you. So, you think like you think VCs go away in the future with AI? Does AI get sufficiently powerful that it can judge and generate alpha better than the best managers in the world, or do you think that it's always going to have a human in the loop?
So I've been in AI for most of my career, right? And while I can never say that a singularity point might happen where algorithm can completely take over, I think specifically in certain areas, I think AI would find it very hard, at least given the current state of data and algorithms. And the reason for that is these certain areas are areas that are truly emergent in the sense that there is no real data historically to indicate whether this will work. So when you're in the true unknown and there's not much data behind you to help train an AI, it's very hard to imagine how an AI would handicap a brilliant new idea. I think the best AI algorithms would find the optimal strategy to be just waiting and figuring out whether the idea actually works before investing. So I think the way in which the future is that all of us investors are going to be way more ably supported in not just finding the companies, but evaluating and assessing them. But finally, it will still be very much a human decision to make that leap of faith in some cases, in believing in the founders, believing in their ability to navigate the future, and truly the innovation that is held in the idea before it gets realized. And this, by the way, is coming from a person very much steeped in AI. So I very much understand the value an algorithm brings to the table. As of how it stands today, I don't see a replacement, but I think we will be very much assisted and supported by AI.
Yeah, I personally can't wait. I think I have a willingness to pay. I have an AI background as well, not as deep technically as you. I mean, I built a bunch of AI stuff and led AI at AWS and stuff like that. So I built a lot of AI over the years, and a lot that didn't work. And personally, I think as a VC, if somebody could show me like, hey, I have this algorithm and it will scour Crunchbase and PitchBook for you, and based on your criteria, give you the top 10 or 20% to look at, I would pay for that right now.
Exactly. So that's exactly what we do, except we don't sell it to anybody else. We use it internally ourselves.
Yeah, totally. Something about the how AI is getting injected into the venture capital ecosystem.
So I can answer a few of those. For example, there's a lot of uses of AI. We currently use, apart from the mainstream AI algorithm, we use actually specific Gen AI algorithm quite a bit in our practice. One of the key things that is hard to do, and humans do it still slightly better, is reconciling a lot of conflicting information. And when you start looking at companies from a data perspective, is when you realize how much conflicting information there is today. Let me illustrate that with a very simple example. Even a company's founded date is not a fixed point. Is it the date they registered the website? Is it the date they registered the Delaware LLC? Is it the date that they made their first product announcement? Is it the date that the founders changed their LinkedIn profiles? Different people grab onto different dates and say, hey, this is the date. But who knows what the real date is? Because startups are very organic, right? You don't even know when you're going to start a company. You launch the app first, and the app gets traction, and then suddenly you go run out and create a company. Which is first?
Probably when you first get revenue, maybe like the first revenue date.
So again, not every company is in revenue, right? They are looking to build in audiences and so on.
But first line of code.
Right. So, but why is this important, right? The reason why the founded date is important is that we find that age is a very good indicator of the potential of a company, because age in some sense affects the comparison set, as in, are you going to be a great company? Well, you're going to be a great company if you look great in comparison with your cohort, and your cohort depends on age. And so understanding that cohort, understanding those comparables allows us to predict very well who's likely to be an outlier. And so hence the founder dead date is important. But even that, since that date is hard to come by, we find that LLMs are able to do a much better job of bringing all of this information together and picking what's the most likely relevant founder dead date. And we find that very exciting. It's something humans do, but we take a little bit longer, right? We have to look at all of these pieces and then say, okay, this is the date. And LLM does it in micro.
Yeah. So without giving away too much of your secret sauce, what are some of the must-haves when you guys are looking at those 25 investments at the Series A stage? What are some, call it rule of 40, burn multiples, whatever it is? Like, what are some kind of must-haves where AI is serving it up, but you're also kind of going through your DD checklist and kind of saying, okay, it has to have this, has to have that?
Sure. Again, as you said, I shouldn't be giving my secret sauce away. So I'll actually point to...
You can keep it general, yeah.
I'll point to two specific things that I think will be very useful and perhaps also tells you a little bit about what kinds of companies we like. So the first and foremost that we like and we try to handicap as much as possible is what we call a sustainable growth engine. And the reason why the sustainable growth engine has to be identified when the company is important is we find that the best proxy for eventual success, how large the success will be, how confident or probable the success will be, all is a function of growth.
Yeah.
But it's not any growth, right? You can throw marketing dollars at something and make it suddenly grow. So that's why the key is the sustainable growth. And then the third word, engine, indicates that it's repeatable. So hence the real secret of what it is we are looking for from an algorithmic perspective is the existence of this sustainable growth engine. And so that's one. The second is the ambition and profile of the founders. So even if this exists, really who runs and uses the engine are the founders and the team who can really realize the potential of it. So if you think of this engine as that potential, then the executors or the folks with their foot on the accelerator are the team. So understanding how ambitious the team are, where they are ambitious and yet humble, right? They are looking and seeing far into the future, but they are not stupid enough to throw money at the problem or do unsustainable practices in order to cover the ambition. They're also not so disfocused that they are always shuttling out towards the newest, shiniest thing, but they're focused enough, but at the same time aware of what is happening there.
Yeah.
So these are the two biggest features we look for in a company, and they are necessary must-have before we consider it.
I 100% agree with everything you said. I mean, as a pre-seed investor, those are probably the two most important things that I'm looking at too. And I think back to all the best companies I've invested in, they were growing in a very capital efficient way very quickly when I made the investment, even at the pre-seed and seed level, doubling revenue every month kind of thing, 50 to 100% growth. And so you're kind of looking for, there's an inflection here. There's something here. There's some PMF. They're acquiring customers at a rapid rate in a very efficient manner. But I'm curious, how does the algorithm score ambition?
The algorithm doesn't. It does identify several characteristics of the team.
Yeah.
But like I said, the final decision is after we talk to the company. So again, this is why I say, right, the algorithms get us into the ballpark. So the several characteristics of the team and the company are already sort of vetted from a data perspective. But then finally, when we do talk to the company is when we realize, ambition alone also doesn't really necessarily work, right? So the team have to be of a quality where they're both ambitious, but then they're also able to execute on that ambition. Which means they're able to hire people, they're able to convince others to join them and so on. All of those things are what we evaluate when we talk.
Yeah, and I think that's the founder team kind of thing, right? Because you're looking at the founders, if they've gotten sufficiently far to get to like a Series A round and they have millions of ARR, they're probably pretty impressive people. And now you're kind of looking at like kind of who are they hiring? Who are they surrounding themselves with? What's the quality of their advisors, the quality of the E staff and some of the team members they've hired? I was debating this with an LP recently. He was really, really digging into each of our founders, their pedigree. He was very hung up on Ivy League education and things like that. And I was like, well, I think unicorn founders kind of come from everywhere. and like, I'd love to get your thoughts on that. Like, where do unicorn founders come from? Because that's what we're all looking for, right? We're all looking for these companies that can go to be a multi-billion-dollar company.
Absolutely. So you're absolutely right. And our algorithms do show that unicorn founders can come from anywhere. And this is the reason why our approach finds the best companies without these kinds of obvious biases. But having said that, there is significant value in pedigree, and it may not be exactly what most people think. It's not necessarily the education they get, for example, at Stanford or at Harvard or at MIT, but it's the fact that in those places they form a network, and that network becomes very important. They get some of their best advisors or their first backers from their alumni or from their professors or from people whom they've met, right? So those play a little bit of a more outsized role than actually the education they get from having gone to Stanford or Harvard. So that does give them a significant leg up. But there are other proxies that can sort of balance that. So, for example, you didn't go to Stanford, but you are of high enough of a quality to get hired by Google or Meta or OpenAI. Then those speak for themselves, right? So there's enough countervailing factors that we can identify in the data that tells us the likelihood of this being a rock star, outstanding founder, and it's not just alone about educational ability. But in the absence of all of these other things, then yes, education is our best route.
Yeah, and I like that too, because it's just not one thing. It could be multiple other things. And you're kind of looking for lines, not dots, right? In the person's background, it's
exactly.
It's about the quality of work they've done, with whom they've done it, over what period of time. And we actually have a Y Combinator focused fund. That was our first fund that we started a few years ago. And go, make 10 or 15 investments per batch. So we go meet all the founders from YC, not all of them, but probably like 80%, something like call it. And they're all of that background. They're all highly educated, highly ambitious, with a history of success at the biggest name companies and startups in the world. I mean, it's almost like all YC does is they just take a batch of thousands of applications and they go like, who are the most ambitious, capable people in this batch? And let's just put them to work on problems. I mean, would you agree with that statement?
For the most part, I would. I think so. YC is, I think, very interesting in different ways. And once again, I think it's unclear sitting outside how much of the value of YC is in the entry point selection of people and how much of it is in that network. Because I don't know if most people realize it, but when you have the founders of Uber and Airbnb and legions of unicorn companies who are just one click or one call away in terms of getting guidance and advice from you, how much of an impact that has on your ability to own or change your startup strategy, I think that is very sort of undervalued without knowing the value that it brings. So once again, I come back to the fact that it's not so much what you do as much as those lines, those connections that you have. Because the right suggestion, the right framing of the problem when you're stuck at something might completely change how you see the problem and hence unlock the sort of the next level, if you will, for yourself. And I think that's in some sense a lot of what YC does. YC does through immense support structures provide the best way in which you can sort of think about your problem. You would be doing the YC a disservice if you just went through YC, just sat in your box and did your own thing and never used any of this support.
Right. Yeah. And there's a lot of founders, like you said, helping founders. I love that. That's why we called our venture firm Team Ignite. We realized right at the start, I mean, we're going to have to build a team that ignites startups. It takes a village, right? It takes that network to actually have great outcomes. I mean, absolutely. On average, I'd say. I'd love to kind of switch gears and talk about how you see venture capital changing. I mean, you've been around it for a while now. How have you seen it change the last 5 or 10 years? How do you think it's going to change in the next 5 or 10? And what are kind of some of those long-term trends that you see happening?
This is a very interesting question. And first off, I don't want you to think we are too arrogant, but we think we are one of the big change makers in VC. From the perspective that not a lot of VCs use or follow a sort of a rigorous, disciplined, data-driven approach or forget data, just a disciplined approach to their investing process.
Or we do, but it's just all subject to human error, right? Because I'm personally looking at 500 decks, and I have a rubric, and I score everything, and but I'd love to have AI that does that for me.
And that's exactly what we are hoping for in some sense, right? Is that we feel like one of the big things that will change is the ability for VCs to access and sort of distill enough information in order to have the right information be upfront available to them for making decisions. So that's going to be a big change in their internal process.
Well, kind of in the same way that it is in public markets, right? If you think about public markets, there's a pricing theory in public markets, and it's to say that, hey, everything's accurately priced over the long run. Maybe not in the short run, but definitely over the long run, because everything's public, known, and quantified, and arbitraged. And it's actually in the earliest stages that you get a lot of this alpha, because there's just imperfect information and network asymmetries, and that you just don't get in the public markets as much.
Absolutely. And so what I do expect to happen is I expect the flip side of this equation is that the concept of stealth startups reduces quite a bit. Now, the innovation and the idea itself might be still kept stealthy, but startups, I think, will feel very rapidly the need to publicize what they're doing, not just to attract investors, but to attract other team members, right? So, from a hiring perspective, people are going to be looking into saying, so where's your data? What have you done? Where's your revenue? Why should I believe you're going to be growing fast if I cannot see it myself, right? So candidates are going to expect that. Team members are going to expect that. Future customers or partners are going to expect that. So I believe that the amount of information is only going to increase dramatically, and startups are going to get comfortable sharing that. And the second part is the kind of startups are also changing. Before, as we just said, there's a lot of opportunity for teams to come together to work and build on an idea. But now with the advent of AI, the possibility of a solo entrepreneur becomes more and more likely. Where, initially when you're starting, you thought you needed other co-founders because there were things in your skill set that you didn't have that you needed for building this idea. But tomorrow there may be an AI co-pilot. Let's say you're a business person and you need a coding co-pilot. You just get the coding co-pilot to build it. So you will see a lot more companies in its initial stages where they are solo entrepreneurs. And so I think early stage investing will change dramatically to figure out how to even understand and handicap these kinds of opportunities. And there will be a lot more aggressive and active sort of M&A process, because I think it's very much likely that a person will start a company, build on an idea, and be willing to sell it in 1 to 2 years because they've been working on it for a couple of years with this AI support sort of support system. So that's one set. On the other side, the VC change, I believe that it becomes literally dumbbelled in this following process, where there's two kinds of VCs. There's large generalists who are going to be investing in everything and anything, and they will come up with, similar to us, algorithmic processes and internal organization, and they will invest in everything. And then on the other extreme, there will be extreme specialists who will only invest in certain things, and they will do this very, very well, but they will keep their focus very narrow. And this vast middle ground will drop out. So the fact that you are a mid-sized fund that invests in X, Y, and Z will go away. You will either invest in everything, or you will invest very, very specifically in small.
I love that. I love that vision, and I think it dovetails a lot with kind of what I'm seeing in venture. What I think I see is, an increase in the velocity of startup creation, which I think you described as like lots of solo founders with AI co-pilots generating more software. Software is eating the world, not AI is eating software. Generating more software, which is, reducing the inputs to making software, which is paradoxically increasing the demand for software, and it's fitting into every nook and cranny. And I love that dumbbell analogy, right? Because I think another way of saying that is like the middle is not a good place to be, right? You either want to get big and have like this general strategy like what you guys have, which is algorithmically driven, or you want to get small and be really, really niche-y and really, really good at your niche, like biotech or new drugs for cancer, whatever that is. Yeah, I love that. And it reminded me of a study I heard about on Planet Money, where they took AI and they implemented it into a call center. And it was a co-pilot, right, for customer support. And the star performers, it didn't affect their performance at all. They were already star performers, right?
Exactly.
But what it did is it took the bottom performers and made them star performers. And so we might be seeing like a regression into the mean of capabilities, where there's basically a regression to a rising tide mean of capabilities, because AI can make even the lowest performers perform like high performers.
Absolutely. I think the standards are going up every day now for what is an acceptable seed stage startup. I used to remember the days back when you would get funded just on a PowerPoint. Now you walk around with a PowerPoint, nobody is willing to even think about offering you money, because it's
like, what have you built? Yeah. Do you have any customers? Yeah.
Why haven't you built it yet?
Yeah.
Right?
Yeah, exactly.
And now things are even further. So if you have built it yet, why haven't you tried to sell it yet? Right? Why haven't you gotten your first set of customers? So I think the bar is always going to keep rising.
Yeah.
And as the costs keep coming down, the more can be accomplished with little, and therefore I think the quality of the companies that make the cut also increases. And so I think this just leads to much more acceleration in the level of invention that's going on today, because it's literally like so many startups are going to cross the finish line, which means every area of human endeavor potentially can be impacted by the rate and pace of innovation.
Yeah, and it's so exciting, right? It's 1,000 flowers blooming. It's almost the best time to be alive right now in the 2020s and 2030s. We're going to see just amazing wealth creation and a proliferation. I'm running into companies now that are raising their first round of financing. They bootstrap and they got $1 million of ARR, and nobody works for the company except the two co-founders. Mm-hmm. What's the most extreme example you can think of off the top of your head in where it's like they got to X revenue with a really crazy burn multiple or very few employees? Have you seen anything outlandish yet?
The only place I've seen this, of course, there's the WhatsApp story, but that's
that's a bit extreme. That's a great example, actually. That's a company that got acquired for $27 billion, and they had 43 employees.
Yes,
that's insane.
Yeah, and when they initially started and they got their even their first round of funding, it was, I think, 6 people. But it was an app that was used and loved by a tremendously large number of people in the world.
Build it once, scale it to 1 billion people, get acquired for $27 billion. My first job in tech, I worked, and you'll love this, I wanted to work in solar because I wanted to solve climate change, which we could talk about. And I was director of energy policy for Sierra Club in the state of Hawaii before I came to California. And I'm lobbying the government, trying to get all the clean energy laws through. And so when I moved to San Francisco, I wanted to work in solar. So I worked at a solar startup in South Park, 1 block off the grid. And we're backed by NEA. And we shared an office with Instagram. And so that was my first introduction to tech. Here I am at this solar company, and we're kind of like flailing and not doing well. And then Instagram over there across the office gets acquired for $1 billion. It's like, wow, that's it's, you hear about it like in the news or whatever, but to be there and see it happen, it was pretty breathtaking.
Oh, I remember this as well. So our offices at Lockbox were on 2nd and Harrison.
Oh, right around the corner. Yeah.
Right around the corner. And one of my favorite restaurants was this Korean burrito place called HRD.
HRD. Yeah, right. The Korean burrito. Oh, I remember that. Yeah.
And guess who I run into at HRD? The founders of Instagram.
Yeah. Yeah. It was like 2 doors around the corner. That's where their office was. Yeah.
Absolutely. I think, it's amazing how real things can be built from very, very small beginnings. So it's quite exciting.
Yeah. You find this core need, and I'd love to go back and look at the seed deck of Instagram, or like their first round deck, and just see what's in there. And I haven't done that. I should do that teardown, especially. But what's funny is I probably would have passed because I don't do consumer.
No, what's actually interesting is even for us, right? So we on our first fund, we are on our ninth year, and we always, have updates every year for just our own internal sort of understanding of how our portfolio has been performing. And so I went back and looked at our second and third years companies that we were excited by. And the funny part is, only one out of those four companies has made it to the end. But actually, the returns from several other companies we thought we weren't excited by have really outstripped the performance of that company. Right?
Oh no.
So you never know
You
where
just never know.
all
Yeah.
of this is going to come from, because at that young an age of these companies, you don't understand completely how they're going to transform. You do see the kernel, but you don't know it's going to catch fire so quickly, and it does. And so that's part of the excitement.
Yeah, and that's part of our strategy, right? I don't know how many seed fundings there are worldwide. Last time I looked, it was like something like 8,000. Maybe it's 16,000 worldwide. Maybe it's 8,000 in the US. And so I think our goal at Team Ignite is to try to be in the top, call it 1 or 2% per year, which requires a huge fund, obviously, right? Because if you're talking about 16,000 and a couple of percent, I mean, you're talking about hundreds of companies. And I guess you could call that spray and pray, but I call it like, invest and pray or something else. But you just, like, because you never know, like, and that's how we approach investing too. Is we'll look at everything, and we're only investing in 1 or 2 companies per month, and it's you could call it the top 1/4% of what we see, top 0.5%, but we have to you have to say no so much to make any reasonable bets. What do you think about climate change? Do you think that's a solved problem, or do you feel like we got to work on it?
So I'm an optimist, and so I believe
Me
it will
too.
get solved.
Yeah.
But at the same time, I am alarmed at the lack of pace at which things are being done, and especially by nation states. Our country, other countries in the world, they make promises but don't deliver on those promises, and so that's been a little disappointing. But that said, I believe we will still solve it, because I think there are so many passionate people about, and this just needs a lot more attention and a lot more approaches. And it's such a multidisciplinary problem that there are so many different people who are coming at it from different areas and places. So this is the reason why I believe it will be solved, and we will solve it, and we will come up with much more innovative solutions. But at the same time, I am concerned, mainly because of the pace and the lack of governmental support and focus.
Yeah, one thing I was looking at when I kind of got into tech, and I've been a student of Ray Kurzweil since his 1999 book, Age of Spiritual Machines, I think it was, and then Singularity is Near, of course. But in it, he basically points out, he's like, hey, we've been doubling solar capacity since the late 70s at a very predictable rate, every 18 to 24 months. And, we're only about 8 or 9 doublings, I think he said in the book, from having like 100% solar energy. And, that sounded outlandish at the time because it was like $5-6 a watt. This is 2011. But now, the levelized cost of energy for solar is way cheaper than anything else if you install like megawatt scale systems. And that cost continues to drop. Every time it doubles in installed capacity, it goes down about 15 to 20% in cost. And we keep unlocking things, right? So there's almost like a Moore's law to electricity generation. And then you layer on other sources, and I'm pretty bullish. I'm such a techno optimist, probably more so than you are even. That I feel like, we're in really good shape. I have 16 kilowatts of solar here in California on my roof, and I'm driving electric cars, and so I'm pretty bullish. But there's also this thing that happens, right? The Jevons paradox. Where you decrease the cost of gas and more gas is used. And so the energy consumption will only go up as our civilization gets more advanced. And so we're just going to have to continue to find cheaper and cheaper sources of energy.
Right. So I agree that I am optimist, and you probably are more optimistic than me. But where my fear comes from is in watching several of the more extreme events happening around the world in terms of climate-induced forest fires, cyclones, flooding, and so on. Because it seems to me that we are sort of dabbling with a system that is quite fragile, and we don't know which domino is going to fall, and that's really where the fear is. So, given reasonable amount of time, I'm highly confident, just like you are, that we will solve it. It's just that I don't know when of these catastrophic events will hit, and how easily we are going to get to that transition without something big happening.
You feel like SpaceX gets us to Mars? Elon's going to get us to Mars in the next 20 years or whatever, and we'll be a multiplanetary species?
I don't know if it's SpaceX. I think they're the most likely candidate, but absolutely, we are going to be a multi-planet species. I think I'm very confident of. Will we have habitats on the moon? Absolutely. Will we have habitats in space? Absolutely. And near planets are almost always a given that we're going to expand. Now, interstellar space, that I think I'm a little bit more cautious about because not cautious, I mean, a little bit more careful in projecting how soon, because that seems to require actually a fundamental discovery, not yet within the realms of our current physics.
Right.
So I think may take a little bit more time. Maybe it's going to be an AI algorithm that discovers what drives. And
feels like every day there's a new paper where AI discovered some new thing. Like you saw the Mathematical Olympiad paper that was recently published where it can get gold medal level at the Math Olympiad, which was like a lot of people are saying that's a real harbinger of AI.
Right, exactly. So I think that's why I'm pretty optimistic. But the near planets and in space habitats, I'm pretty reasonably confident of. It's just a matter of time.
Yeah. Well, why don't we switch to a quick rapid fire in the last few minutes here? What's one startup sector you're most excited about right now? And don't say AI. I mean, say something like, I don't know, AI for X or something.
I understand. But this is a sector that I've been very interested in and very hopeful of, and I still haven't seen the explosion happen yet. Genomics.
Yeah. Being able to basically reprogram our DNA and...
Well, we first of all don't even understand how our DNA really fundamentally works.
Right.
I mean, every day we are learning, and we think our entire genomic sequence, most of it is not useful. But I actually don't believe that.
Right.
I think every part of our DNA is actually used and read by our body. It's just that we think it doesn't.
We just haven't identified what that other 80-90% junk DNA is, what scientists have termed it.
Exactly. And you can't actually do an A/B test by removing it and seeing what kind of human gets created, right? You don't know. You can't do that. So you really have to understand fundamentally how DNA works before you understand the meaning of that vast majority.
The gene therapies coming out right now are pretty amazing. The ones I'm hearing
about. They are. Though, like I said, I think what you're hearing is only the successes. What you're not hearing is that 70-60% of the time they fail. So when they work, it's like magic. But a lot of times they're failing. So we're still a little bit away from the precision medicine that one hopes for. But it's just a matter of time. I mean, what we are, for example, today seeing, and then this happened with other things as well. I mean, the amount of money it takes to put a kilogram in space has gone dramatically down, right? SpaceX brought it down to $1,000 a kg. Similar to that, the amount of cost to developing a full genome sequence has dropped from millions of dollars by Craig Venter all the way down to now sub $1,000. We are looking at full whole genome sequences being sub $500. Which means if you get enough people and their genomes as data, you can actually do enough research to figure out what this particular mutation does, what that particular sequence does. So I think this is going to change things tremendously.
Yeah, especially as we're collecting data on everything. I'm doing the every 3 months they take my blood and give me supplements thing on Life Force. I don't know if it's working yet. I think I feel better when I'm taking my supplements, but you combine that with Fitbit data and all the different data inputs, and then you start tracking people's DNA over time and how it changes and expresses different. You could just see an explosion. Kurzweil talks about this a lot in his book, right? Biology becoming programmable. Really exciting. What's the best piece of advice you ever received?
This actually came from my fellow partner when I went out to start a company. So, I had gone through the experience of a startup already. I thought I knew everything that is to know about startups. But I then went and asked my fellow founders, what do you think I should know? And they said something that I now truly understand the meaning of today. I was told the biggest problem I would face would be the people. And I didn't understand it completely as much as to say, but what people? I mean, all I have to do is interview and hire good people, but actually, the people-related problems are the hardest problems in the startup. Whether it be whether you're trying to convince investors, whether you're working with your co-founder, whether you're hiring team members, how do you hire an exec, how do you motivate your team? All of those problems were much bigger challenges than writing a piece of code to solve something,
Right.
or inventing a new algorithm, or coming up with a new marketing strategy. Those were easier compared to the people problem. So learn and understand and find ways to cherish the people around you, because those will be the most important and hardest things to work.
I love that. Yeah, it's about the people. Yeah, and the older you get, the more you realize that it's just about the people you surround yourself with, and that's why I do the podcast, so I can talk to interesting people like you. Gives me an excuse to chat it up with interesting people for an hour. If you weren't in venture capital, what would you be doing?
I think I've sort of done that, and I would want to continue to do that. I would be in a NASA, like in a space like company, working on something that goes out.
Yeah, there's so much space tech happening right now because SpaceX is creating this whole new industry that didn't exist before. Space tourism, and you talked about the kilograms, the cost per kilogram to get to space, and that continues. I mean, I think we're just going to see an explosion of interest, and there's asteroids out there that have trillions of dollars worth of minerals, and
absolutely.
It's amazing. So I really enjoyed the conversation. Thanks so much for coming on.
Oh, it's my pleasure. Thank you so much for such an engaging sort of discussion about such a wide variety of topics. I certainly enjoyed it. I would want to plug my fund, though. I would be remiss if I didn't do that. Since we both are investors.
Yeah, do it. Yeah.
If Rocketship sends you an email saying our algorithms found you, don't think it's a spam email. Please respond.
I love that. So there you heard it. If you get an email, it's a real one. Thank you so much.
Thanks so much, Brian. Fantastic talking to you.